This is Tommy Ruke, and we're looking at our second part of a four-part program concerning government regulations for motor carriers presented by the Motor Carrier Insurance Education Foundation, the Transportation Risk Specialist. If there are any questions that you want us to address directly, put in the chat window. We'll attempt to answer these as we go on. If not, we will answer them through email, and if it's appropriate, share the answer with everybody. If there's any auto problems or other problems that you have, please either put in the chat window that you're having difficulty to hear or other problems, or call our 800 number, which is on the bottom or also on the front of it. It's 800-741-4084. This program will be recorded and posted on our website for your review, but you would not get CE credit by taking it on the website. The only way you can have CE credit is taking it through the 3 times that we're presenting it live. So let's get on with the program. Man, driving a truck is a hard job. It's long hours and difficult environment. I don't know how long y'all have driven on the highway and got frustrated with traffic and weather and rain and snow and those things, but think about having to do that as a living. The other thing is a truck driver is told what they can do and what they must do, from where to be to when they have to sleep, and they live in the glass. It'd be like if everything that you did wrong in your office was recorded and posted on the website. Because if they do something wrong, the government is there to correct their mistake. The company they're working for is cited for a violation. This affects the company's safety record, which affects the company's ability to obtain load and insurance. This stays with the company for 2 years. It is available for public view. They also have the situation the government cites them for on their record that stays there 3 years if you're the driver. So both the motor carrier and the driver is cited for any roadside inspections that reflect violations. Think about it. Have any of y'all driven in heavy traffic, have to stop on interstate highway because of an accident, or just, as I often do, coming out of I-4 out of Orlando, Disney World, letting out at the wrong time? It's rain and snow, beside a car or a motorcycle who whips in front of you and cuts you off. All this, and you have to be somewhere on time. Also, some people like to see their family more often than a couple of days a month. And without doubt, your bed is more comfortable than a sleeper. And what does a driver make? This is one of the positive things that's happened in transportation in the recent past, is the driver's income has gone up. Some of you all have Sirius radios and listen to the radio shows, as I do, which is a sports channel. I don't listen to Howard Stern or the Playboy channel, but I listen to sports channels and know that a great number of the advertisements on the Sirius or XM radio is for truck drivers. The income the truck driver can make has increased in the past almost 6 to 8 months, from somewhere around 40,000 to now 45 or 55 or 60,000. So the income is up, which has also caused, again, a lot of churning in the industry. But think about all that this driver has to do as long as and as much time as they stay away from their home to make even $50,000 to $55,000 a year. It's a tough job. With that said, let's talk about providing insurance for a motor carrier. First off, the question is, what's a trucker? What is the distinction between use of the commercial auto, meaning a private carrier, and a trucker? From the federal definition, both of them are considered a motor carrier. The distinction is made based on what's the ownership of the cargo being hauled. If the hauler owns the cargo, then they are a private motor carrier and then generally classified as a commercial auto user. If the cargo is being hauled is not owned, then we call them a for-hire motor carrier. And in the past, that's the ones that we have called truckers. When you look at the overall operations, what is the big difference? One of the things is, from an insurance standpoint, most carriers rate or charge less for a private carrier. In fact, I had a discussion just today with a retail agent talking about how they classified the difference between a private carrier and for hire, where when the classification changed, the premium doubled. So what makes a private carrier more attractive as an insurance risk? First off, they're more predictable, meaning that they tend to have the same routes and the same routes every day. Plus, they exercise more control usually over their drivers, and most of their drivers are employees, where in the for-hire industry, there's a lot of independent contractors. And they were also better financials. When we step back and think about that, when we look at talking about maybe providing insurance for for-hire truckers, these would be some of the considerations that I would want to think we would want to, as a retail agent, express to the carrier, or as an underwriter for the carrier to consider. How well is our motor carrier financed? Fortunately, today, the finances have gone up and the motor carrier is making money. Are their drivers go on dedicated routes, meaning do they have the same routes and routes on a regular basis so they're not in unfamiliar territory? And does the motor carrier control their operation of their trucks? Simple as do they make the driver wear their seat belts? Do they govern their trucks? Do they have communication? All these things are consideration when we write a for-hire trucker, and we can learn from the experience, in my opinion, from how we look at the private sectors. So as we move forward, we are going to talk about insuring the for-hire trucker, but these are the considerations. One other thing with the for-hire trucker is the problems of radius of operations. If you're ISO dedicated trucker or dedicated insurance carrier and you file ISO rates, you know they have a radius rating of 0 to 50 is local, 50 to 200 is long haul, and intermediate, and 200 above is long haul. Truck specialty carriers don't use this radius of operation. In fact, most of the carriers don't like risk 0 to 100. There's been many studies that show that for a for-hire carrier, we're far better off insuring an 18-wheeler, a big truck, on interstate highway than in local traffic, much less as ISO and their rating will require us to do and give a credit for operating, quote, close to home. Most carriers look at that earlier radius with some suspicion. 0 to 300 would be a local trucker, and 300 to 500 would be a regional trucker, and 500 would be a nationwide hauler. Of these radiuses, the most important one is 300. This is because of the hours of service and how long a driver can drive a day. With the hours of service rules, 11 hours of driving, 14 hours of working, and we can talk later about the new 30-minute break they have to take in the first 8 hours, or after they have driven 6 or 7 days, depending on the number of hours, 168 hours in that period of time, they have to take a 34-hour restart. But basically, 11 hours a day is all they can drive, and there's another 3 hours to take care of that 30-minute break and any other breaks they need for human nature or food or those things. So when you think about them driving 55 or 60 miles an hour, the most they can drive in a day would be 550 to 600 miles, which takes you beyond the 300-mile radius. So providing insurance together there, then what happens here is the driver has to stay out overnight during the trip. They cannot return back to the same place they started from. This is a major consideration because now with a driver over 300-mile radius, you now limit your driver pool, because not a lot of people want to stay overnight. This increases the turnover and also tends to have a new routes. In other words, the dedicated routes that we talked about earlier sometimes are not as predictable. They cross state lines. So now they have to deal with, if nothing else, going through a weigh station or port of entry entering to the new state to make sure all their paperwork is in place and their safety records there and the tendency to be inspected when they cross those lines. Plus the driver is paid by percentage of the revenue, in other words, what they own. They're not subject to overtime, but they're also not paid for the time they work. These all create a problem. The other thing that a for-hire trucker will do different from a private carrier is they'll use autos they don't own as a part of their business, or they'll allow other people to use their autos as a part of their business. This is a major insurance concern. No other businesses normally will use autos of others or allow another business to use their auto. In for-hire trucking, this has happened often, whether it's brokerage or using owner-operators or trip leases. We'll discuss these subjects at the next seminar we do in these areas to explain that difficulty that this causes from an insurance standpoint. One of the things that we suggest when you are a retail agent and approach a risk is find out who their customers are. The fewer the better. In other words, when a motor carrier is dealing with the source of revenue, the more they do with one customer, the better the risk they are. Getting back to dedicated routes and the control factor. One of the ways that we can find this out is to tell the insured, one factor in providing insurance to you, motor carrier, is to meet your certificate requirements for insurance so you can obtain loads. Let us know who your customers are and what those requirements are so we can be prepared to meet the request when putting coverage in place. I had an example one time where I was called by an agent and they had just changed insurance carriers, and this agent's #1 customer now would not let them in the yard because the new carrier would not meet the insurance requirements of their customer. And so this created a problem. What usually is looked for is auto liability, cargo, general liability, and work comp. Of course, the work comp creates a problem if your drivers are independent contractors and are covered not by true work comp, but OC Act policy. Again, we'll discuss that at a later seminar. The other requirements that the customer will put on is the limits, the additional insured requirements, the hold harmless agreements. They will request waiver subrogation, and they'll ask for the coverage for primary and non-contributory. These are the requirements that most customers will require us to make. And a lot of insurance companies have difficulties in meeting these requirements. Something that I teach in class, and if you look on the TSR website, we actually wrote a paper concerning meeting your customer needs that explains how the policies deal with all these requirements. I suggest that you refer to that so that you know this. From a simple standpoint, from a business auto policy, by the way, the requirements for additional insured, the insuring of the hold harmless agreement, the waiver subrogation, and the coverage being primary and not contributory is already built in all auto liability policies that you write without endorsements. This is not clearly understood. Again, I refer you to the blog that we did on meeting the customer's needs on the TRS website. Let's move on. Choosing insurance carrier. Do they understand trucking? Do the claims adjuster know trucking? Had a call today where a retail agent was concerned because an insurance carrier that he placed the trucker with paid a claim that was not covered under the policy. It was physical damage, so it didn't have anything to do with the federal regulations subject to reimbursement. And his concern was, will that carrier now go back against him as a retail agent because they made a mispayment of a claim? My assurance of him is no, but this happens often. The other thing that needs to be considered is, will the insurance carrier provide the coverage to the trucker to match the promised protection found in the proof of financial responsibility or the requirements of their customers? Again, we have those requirements listed before, and they are talked about in the webinar. As far as proof of financial responsibility, we'll discuss that yet later today. The big picture. The Federal Motor Carriers Administration requires businesses, private and for hire, hauling their own goods or others, who uses commercial autos. These are autos that are commercial autos to register, have proof of financial responsibility, and meet operating standards, safety standards. The definition of commercial auto are vehicles 10,001 GVW or larger. That's any unit with 6 tires, whether the tires are large or small, are passenger tires. If you're talking about interstate commerce, this is the user, for hire or private, yes, even ag businesses who cross state lines for business purposes would have to obtain a DOT number. This size of the unit and larger meet that description that we just talked about. The user must obtain a DOT number, and if this is their first DOT number, they'll be subject to the new entry provision, which means that they'll get a call from the federal government to make sure that they understand all the federal rules and regs, and will be visited by someone from the state DOT within the first year of their operation. They also will have to pay a fee as a part of the Uniform Carrier Registration System. They would also have to abide by all the safety regs and rules and be subject for roadside inspections. They might have to meet certain financial responsibilities if they're for hire. The filings that we'll talk about here, if they're not for hire or if they haul exempt commodities, an endorsement, the MCIEF 90 that we'll talk about at the next in the next hour of this CE. Understand the information is also available on the federal webpage, so anybody can view their operation, number of units, where they operate, what they haul, if they've had any crashes, how many units they own, how many trailers they own, how many units they operate they don't own, as well as their safety records as far as their roadside inspection. All this is available on SAFER. And it's available for anybody with a DOT number, whether they are a for-hire or a private motor carrier. Regulation has a long history. It started in 1935 with the Interstate Commerce Commission. When it was started, it was heavily regulated. The key wording in this is commerce. The federal government set up a means so that they could guarantee the movement of consumer goods to foster commerce. They gave authority to provide service to certain shippers. The rates had to be filed and adhered to, and the performance and control was overseen by the government. As some of you know, this also only pertained to processed goods, not agriculture or unprocessed goods. Again, those are the consumer goods. The government decided in their wisdom that things like produce are subject to crops coming in and timing of crops, so they couldn't regulate who could haul those things and not haul those things. So in the terms that we use now, those are exempt. They also didn't regulate people hauling their own goods, because clearly they don't have to have authority to haul their own goods, and there's no concern about rates and performance standards. They take care of themselves. So it only regulate people hauling processed goods, interstate commerce, that they don't own. As some of you might have heard the story when you've been in classes with me, my father was a trucker. His customer at the end of his career was Vlasic Foods, and Vlasic had two needs for him to haul: the raw product, your cucumber from the field, to their processing plant. And then once the cucumber became a pickle, in other words processed, then he would haul the cucumber that now is a pickle away. He had to have no government requirements to haul the cucumber to the processing plant. This was when he was operating in the middle 70s. But he did have to have government authority, and he applied for it in 1975 to haul food goods out of the Millsboro, Delaware plant of Vlasic Foods to the southeast. To do that, he had to go to Washington. He had to prove that no one else could meet Vlasic's requirements. In fact, the certificate he got from the government was for the public convenience and necessity, meaning that he provided or met a necessity of a public by offering this. He had to file his rates. And all this cost up to $100,000, but when he did that, he had exclusive rights to those things, and he had very limited competition, and it was guaranteed their payments. All this went away in 1980. The key part of that is it was not exclusive anymore. There were other things that happened in 1980 that we'll talk about later. That was the introduction of MCIEF 90, and also the increase in the limits of coverage from $300,000 to $750,000, $1 million, and $5 million. In fact, that last increased limits are things that are discussing now, and we're writing information concerning the proposal at the federal level now to even increase those limits up to proposed 4.4 million, but that won't happen, I don't think. But we'll write information concerning that, so look forward. You can look forward to receiving information concerning that increased limit. Then in 1996, the ICC was gone, done away with. Enforcement, everything was moved to Federal Department of Transportation. One of the ironical things I find is I see a number of trucks still running down the highway that says ICC MC number. And I've even seen some applications still asking for the ICC number. There hasn't been an ICC in existence since 1996. Today, everything's overseen by the Federal Motor Carrier Safety Administration, and the registration is the Uniform Carrier Registration System. The key word there is uniform. This was made a part of the ICC Termination Act of 1996. It was put in place with a Safety Lube Act of 2005. This is the registration system. Today, no one cares in Washington who hauls anything. So the old ICC focus on commerce has gone away. The new focus now is safety. Everything coming down from Washington is so that the highways become safe, which is kind of ironical because in the last 2 to 3 years, there have been fewer crashes on the highways, at least ones done by motor truck carriers or motor carriers than ever in the history. But the push now is to do everything safer, which has the enforcement of the safety regs and rules. And again, this enforcement is reflected on the motor carriers operation through their inspections that they have. This is, as you would know, would be in safer and a part of CSA. That is the discussion that will be the 4th hour of this 4-hour presentation, and we'll look in depth in that. So the government regulation, you must gain permission for the government to operate interstate. Who must do this? A motor carrier using auto in interstate commerce, 10,001 GVW or larger. They must register. Anyone, private or for hire, that uses an auto with 6 wheels must obtain a federal DOT number. And some states require those DOT numbers. Again, some 30 or so listed states would require a DOT number. The form that would be used currently to obtain a DOT number and to increase the or to change their regulation is the MCS 150 form. They must pay a fee. If they're 10,001 GVW and have a DOT number, they must pay a fee to the Uniform Carrier Registration System. 2 trucks are $76. There's 5 brakes within the braking to the top level of over $11,000 if you have over 1,001 trucks. There's also another provision, and this is the tax distribution provision, again applying to all holders of DOT numbers, private or for hire, if their vehicle is 26,001 or larger. This is a true big truck. These are the IFTAs, which stands for International Fuel Tax Agreement, and IRP, which stands for International Registration Program. And this is where the trucker pays for their reports to the federal government the fuel they purchase in every state, and the distribution of the taxes, including in the fuel purchase, is then distributed not based on where they buy the fuel, but where they operate the truck, reflected on that report. When we talk about in the next section the need to gain information about the insured, the IFTA report becomes useful to us from an underwriting tool. The International Registration Plan, you can look on the front of a license plate and it says apportioned. What's apportioned is a license plate fee, not based on the state they purchased it in, but based on the states that they're going to travel in as reflected by the application for the license plate. This is where the license plate varies between $1,200 and $1,500 to $1,600 depending on the percentage of time they spend in each state, since every state has some different level of requirement for a license plate. In some cases, there also might need a proof of financial responsibility. If they're hauling processed goods of others, interstate commerce, in other words, my father hauling the pickles, not cucumbers, they must now obtain an MC number, and that must require proof of financial responsibility. The application for the MC number is an OP1 application. The federal government current financial responsibility requirements, again, certain motor carriers, those hauling others' processed property across state lines have to get a franchise, an MC number, from the government to haul this property of others that has been processed across the state lines. This only represents about 30% of the truckers on the highway today with DOT numbers. They also must register under the Uniform Carrier Registration System. This is a fee-based, and there will be new publications concerning the rules for financial responsibility. The UCR no longer recognizes a trucker for being exempt, no longer recognized by cargo. There's no longer any common or contract carrier. A motor carrier will register and obtain a DOT number. In this case, the new classification is, are they a motor carrier, are they for hire, and are they hauling processed goods or not, hazardous goods or not, and are they for hire, hauling hazardous goods, people moving in storage. The reason you have the subclassification is because you now have additional liability requirements if they're hauling things hazardous, which could be $1 million to $5 million, or if they're hauling people, which again could be $1.5 million to $5 million, or the moving and storage company requires a cargo filing of $25,000. This is why the subclassifications are there. But this is the new system that we have to deal with. The Uniform Carrier Registration System is based on the fleet being registered, not authority to haul. It's still not complete, as the DOT cannot take information about financial responsibility based on the Uniform Carrier Registration rules yet. However, there is a proposal, and any day now we're looking for the completion of this, and when it happens, you all will be notified, and we'll talk about the ramifications on how it affects us as an insured. But the new application will replace the MC-150. It's a MCSA-1. Just so you understand the comparison of this, is the 150 is a 2-page form. The OP1 is a 2-page form, which means I can become a trucker today with a DOT number and getting operating authority to haul processed goods of others in interstate commerce with an OP1. In the future, the application will be the MCSA-1, which is an over 20-page application, a 20-page application. Now you might say, wow. Well, first off, that is a combination of everything, meaning that if I don't haul people, then I can skip over some pages. If I'm not a household moving and storage, then I can skip over some pages. But it is complicated. It will have additional information available that we have not had before, from the ownership of the company to the financial, to who does the drug testing, who's their safety director. Part of this is under the new MAP program, which has given the FMCSA more enforcement to make sure that a trucker is operating soundly. And second is so that the new ventures are not ones who are trying to wipe out past bad history. And so the MCSA-1 application that has been proposed to be used, and based on information we have, will come in force in the foreseeable future. It'll probably be a phase-in for a year or two, and we can talk later about that in other discussions. But this is what we're moving forward to, all under the Uniform Carrier Registration, which will require, again, the fees might require financial responsibility for the exempt hauler if you're for hire, like hauling the cucumber, or if you're a private hazmat hauler, you would have to have proof of financial responsibility, all having to do under the completion of the Uniform Carrier Registration System. A motor carrier with permission to haul processed goods of others, meaning ones with MC numbers. There were about 76,000 when ICC shut down in 1996. There are over 170,000 today. Again, these are interstate motor carriers who haul regulated goods and have met the financial responsibility requirement by having MCIEF 90 X sent to the federal government. We'll talk about that in a minute. The ironical part about the 91X is that it attaches financial responsibility on any vehicle the insured is using as a part of their operation granted by the government. In other words, being operated under their authority, 10,000 GVW or larger. You would think the federal government could decide if they want to regulate trucks with 10,000 or 10,001 GVW. In either case, though, they're trucks with 6 wheels. That 1 pound doesn't make that much difference as far as you look at a truck. By the way, the MC number no longer has to be displayed on the side of the truck, but the motor carrier still has to obtain one. If you look down the highway, you'll even see some new trucks that will have, again, the ICC/MC number. Tell them to take that off. Save the $30 to have it printed. All that has to be on the side of the truck today is their DOT number, the motor carrier's name, and that's it. Usually there'll be an address and a phone number just for convenience sake. There are over 700,000 people with DOT number. All those are not active. In fact, one of the discussions and one of the problems with the Uniform Carrier Registration System and its funding is that they overestimated the number of the motor carriers. Yes, there's 700,000 people with numbers, but that system has not been purged. And so when you look at active motor carriers, that number is somewhere around 500,000. This is overseen for the carrier's safety and registration and compliance with hours of service and those kind of things. It affects all interstate motor carriers above that we talked about. Those are the ones that have to have MC number, plus an exempt motor carrier, one hauling, again, unprocessed goods, like hauling the cucumbers versus the pickles with the MC number, as well as private carriers. Again, to obtain a DOT number at present, there's no financial responsibility requirement have to be made. Some might have to meet the MCIEF 90, which is an endorsement to the policy that was mandated by the Motor Carriers Act of 1980. That will be a subject for the next 3 hours of CE that we'll be doing next month. Motor carriers who have a DOT number, all private exempt as well as for-hire regulated motor carrier, who operates in interstate commerce and have a vehicle 10,001 GVW. Again, only the DOT number is required to be displayed on the side of the truck. The basis of the Uniform Carrier Registration System is the DOT number. That system, as we said before, makes no difference between regulated or exempt, for-hire interstate motor carrier. No difference between common or contract motor carrier. Everyone with a DOT number will pay a fee to operate and be subject to the safety regs and rules of the FMCSA. The for-hire federal government does have a requirement today. If you're a for-hire, you must make application to the federal government for permission to haul, again, regulated commodities in interstate commerce. This motor carrier has an insurance company file a certificate on their behalf to complete the process. The information concerning about this filing, which is the 91X, is also found in SAFER. Again, in the 4th hour of this 4 hours of CE, we'll look in depth as far as that goes. The certificate is at BMC 91X. When that certificate is filled out, the name and address of the motor carrier must be exactly the name and address that the government knows them by. The way you obtain the name and the address based on what the government knows them about is in the federal web page, SAFER, under the license and insurance regulations. The address must be a street address. This is a street address enabling the DOT officer to go and inspect the location. It can also have a mailing address, but the requirement of the 91X is to have a street address. And again, it must match the name the trucker is, the government told the trucker they're operating under. Now, when we talk about later in the next sessions concerning the insurance requirements, please remember the purpose of this. The purpose of the 91X is to make the motor carrier legal, meaning to meet the financial responsibility requirements imposed by the federal government for haulers of processed goods in interstate commerce. It is there to prove that there's insurance coverage on behalf of that motor carrier. When we set up the insurance policy, we got to make sure that the name insured on an insurance policy is the assets that we're trying to protect. Those assets are the company, depending on if they're individual or a LLC or a corporation. That's the name that's on the policy as a named insured. If the name is different than the name that the filing has to be made in, then we have to walk through that. But never make the name of on the policy to match the name of the filing. The name on the policy is there to protect the assets of that insured. The purpose of the 91X is to get them legal. Those are things that we can work out. Today, we still see some discrepancies in those areas. I think it has gone away in the recent years with the ease now to change those names or to at least have them conform to the requirements of both the insurance carrier and the government so that they're operating the same name. But again, the name that the 91X filing is made on is the name the government knows the motor carrier by, and that's the name that you find in licensing and insurance. When you look at the 91X consideration, and I suggest that this will be posted on our website and you can download it for the purpose of this webinar. It's not here available to be shown in detail here. But there's some considerations that you need to think about. The first consideration is this is a certificate of insurance. It is not insurance. It does not say what insurance carrier has to pay primary or not. It just says that there is insurance in case an accident happens. And when the accident happens, the public is damaged. And there's no one that steps up to pay the claims, meaning that the accident happens and there is no coverage in the insurance policy that covered the vehicles that caused the accident. Then the certificate of insurance is looked at to determine who has to step up and pay. This is a big consideration because the only time the certificate comes in play and only time the certificate is looked at is when there is a loss and there's no one who steps up and pays that loss. Then this is the ability for the damaged party to look to whoever filed the certificate, meaning the insurance company, on behalf of the motor carrier. And that company would then have to address the claim. This is a fail-safe. It's not insurance. The limits required. The limits required on the 91X, in our opinion, should be the limits that are required by the government, not the limits on the policy. Typically, this would be $750 unless your insurers are hauling hazardous goods, which would then require $1 million or $5 million. This is not understood easily because the purpose of the 91X is only to get the motor carriers legal. If the federal government says all they need to be legal is $750, then it's our opinion, or my opinion, that you should show on the 91X what it takes to be legal, and that's the $750. How you find what is required, again, is in license and insurance. We'll go into that in the 4th hours of this educational presentation. That shows what is required. That is what we suggest that the 91X reflects, is that limits that's required. That doesn't impede any ability for your insurer to collect the $1 million or more that his policy or her policy might be issued at. For a covered loss, they have the full advantage of the policy limits as long as it is a covered loss. And the 91X certificate does not get looked at. However, if the loss is not covered, meaning there's no coverage in the policy, then the insurance carrier has to step up and still protect the public. And at that time, what the insurance carrier has done by limiting the insurance limit shown to what is required, they've limited their exposure to $750,000 if that is what is required to make the motor carrier legal. This protects them from having to pay more than what is required to be legal. It also benefits the insured in this area because if a payment is made and there's no coverage in the policy, then the insured has to reimburse the motor carrier for any payment made. And again, because they only have shown the $750,000 on the 91X, and that's all they paid, then the reimbursements, the motor carrier or the insurance carrier seeking reimbursement from the motor carrier is then limited to the recovery of the $750,000. This is not that easily understood. We do have a post on that in the TRS webpage to understand that. Where you typically get pressure from this is when your insurers are dealing with customers, and the customer does not look at anything more than what's published on the website, and they have a requirement for $1 million, and on the website of license and insurance is only showing the $750,000 requirement. But that is important to understand the difference between being legal, which is what the 750 reflection does, and what coverage the motor carrier has within their policy, which would be the full policy limits for a covered loss. There's also one other thing, and this could be a question that we would ask you for a trivial question, is what's the X stand for? This will probably become relevant in the foreseeable future. This was put in place again in 1980 when the limits of insurance went from $300,000 to $750,000, $1 million, or $5 million. In those days, most carriers could write $300,000. Most insurance carriers did not have reinsurance to go over that. So the X will allow the coverage to be layered, meaning that in those days someone wrote the $300,000 and then another carrier made another filing that would be having $450 X of $300,000. So the X allows it to be layered. Since 1980, things have come around, and most insurance carriers don't have a problem doing this, at least at the $750 to $1 million level. However, if the new limits of coverage go in place, where we're projecting that will be at least $1,500,000 requirement, meaning doubled, and again, the proposal that was made in Congress 3 weeks ago was to raise it to $4.4 million. Again, I don't think that will happen, but that ability to layer the basic coverage becomes important as we move forward. We are working on those details now, and we will be publishing a blog and a white paper concerning this. The other important parts on 91X is that on the part of it, it says that there's an MCIEF 90 attached to the policy that the certificate of insurance is based on. The next hours that we do for CE will look in depth of the MCIEF 90. The MCIEF 90 is an endorsement that's placed on insurance policy. It is there for both exempt and for hire, as well as the regulated for hire, people with MC numbers, and some private carriers. The important part of MCIEF 90 is that it spells out how a claim has to be paid. And when the loss happens, the 91X doesn't get looked at. What gets looked at is the MCIEF 90 to determine how the claim is going to be handled. The MCIEF 90 also contains, as we alluded to before, a reimbursement provision, which basically says that if there's no coverage in the policy that the 91X was based on and the MCIEF 90 was attached to, the insurance carrier still has to protect the public. But when they make a payment beyond the policy coverage, then they can seek reimbursement from the insured for those payments. And that's a consideration that we'll discuss in depth again in the next hours concerning how to meet those requirements and where there's no gap in coverage. Both the 91X and MCIEF 90 applies to blanket protection for all activities occurring within the authority granted by the government. This is what causes a great deal of problems with the insurance industry, and it goes back to a statement that we made earlier. The unique part of the for-hire motor carrier is that they'll use autos as a part of their business that they don't own, and they will allow other people to use autos in the other people's business. And so when we're operating under the authority with a 91X, what it basically says is that the protection of the public based on the 91X is for all vehicles the motor carrier uses within the operating authority granted by the government, whether that vehicle is specified on the policy or not. And as most of you know who have dealt with the trucking insurance, that when you insure a motor carrier for hire today, unless they have somewhere 20 units more or less, that policy is going to be issued on a specified auto policy only. This requires any vehicle that's going to be considered a covered auto in the policy to be scheduled on the policy. And what this 91X states is that's the opposite of that. If a vehicle that's not scheduled on the policy, in other words, not a covered auto, has an accident and there is no coverage in the policy, the motor carrier who filed the 91X still has to protect the public. This is the main concern of this, and this puts a burden in underwriting. Again, we'll discuss this later, to make sure that we in the insurance industry make sure that we are covering all vehicles the insured uses and operates as a part of their motor carrier's business within the policies that we are issuing, that we have underwritten their vehicles, we have underwritten the drivers, and more as important, we have gotten the premium for those vehicles. Again, this is the place where the gap in coverage between the promise to protect the public of all vehicles and the policy we issue that requires the vehicle to be specified. Again, we'll talk about coverage later. This is also, the 91X also is a continuous provision. The cancellation provision says that this is continuous unless you cancel it in writing with 30 days plus mailing. Well, like everything that we know, that is not totally true, because there's two ways to cancel it. The first way for the 91X to be canceled is to meet this requirement, and that is to cancel the vehicle, or cancel the 91X with the 30-day mailing plus, 30-day notice plus mailing. Or if the insurance carrier, if the insured has another insurance carrier to make a filing on their behalf, and that new filing is made with the same name and the same limits as the previous filing, then the 91X filing that was made earlier will be canceled by replacement. This is a big provision, and for you who are part of this organization or listening to this webinar who are retail agents, this is consideration that you would want to ask your insurance carrier, because there are two approaches to this in the marketplace. Because of the continuous exposures on the 91X beyond policy terms, some carriers cancel the 91X every year unless they have the order for the renewal prior to the 30 days plus mailing. Some others make a business decision and don't cancel their filings each year. And so you need to find out as a retail agent the position of your insurance companies on these cancellations, because you have to alert your insured that how your carrier is approaching this. And if the carrier that you're writing the coverage for cancels the policy the filings every year, then you need to notify your insured how this works, because once the filing is canceled, then the FMCSA sends a letter to your insured telling them that their authority has been revoked unless a new filing is made prior to the expiration of the old filing. And that letter, most motor carriers gets the letter and they don't read the date that their authority has been revoked, and they start coming out and scrambling for insurance. So you need to look at that. By the way, if they do not meet the new filing by the time the old filing expires, then they would owe a $85 reinstatement fee to activate their authority again. So the big concern here with the 91X is just a certificate of insurance. It's not insurance. What the insured has to protect them is the policy they purchased from you, the insurance provider. This certificate is only there to protect the public when there's no coverage in the policy that was issued to the insured. The limits that we suggest to be shown in the 91X is not necessarily the limits on the policy, but the limits required by the government, which can be found in licensed insurance based on the MC number that the certificate will be tied to. There is a requirement to have an MCS 90, which is an endorsement attached to the policy the 91X is based on. And this endorsement tells us how the claim will be handled. It has additional cancellation provisions in it, plus it has the reimbursement provision in it that basically says that if the insurance carrier has to pay a claim to protect the public because of the 91X or the MCS 90, then the insurance carrier has the rights to seek subrogation or reimbursement from the insured. The place the policy would most often not have coverage and the 91X and MCS 90 would protect the public is if the vehicle the insured is using is not scheduled on the policy, because the 91X states that even if the vehicle is not scheduled on the policy, the 91X protects the public from all activities, any vehicle the insured uses within the authority granted to them by the commission or elsewhere, which means that if we write a policy based on specified auto, then there's no coverage in the policy if the insured uses an auto they don't own. But if that auto is being used under the authority granted by the government that the 91X is pledging the financial responsibility to protect the public, then there's no coverage in the policy, but the insurance carrier would still have to address the damage to the public and again seek reimbursement. Lastly, the endorsement requires the certificate of insurance of 91X is a continuous certificate until canceled, and that requires 30 days. There's two ways to have it canceled, again in writing with 30 days plus mailing, or second by having another carrier make another filing, and if that carrier makes the filing in the same name and the same limits as the previous filing, then the previous filing is canceled by replacement. And as the market now is divided, some carriers cancel the 91X every year unless they have the order for renewal within the 30 days plus mailing. Some carriers do not. And so you need to alert your carrier, your motor carrier, your insured, the status of the position that your insurance company has. Remember, this is not insurance. This is financial responsibility to operate legally. The financial responsibility provided only affects claims when there's no coverage in the policy provided by the insurance carrier who furnishes the proof of financial responsibility. It's a fail-safe to protect the public. So in summarization, all users of commercial motor vehicles, 10,001 GVW or larger, who operates in interstate commerce and crosses state lines for business purposes must obtain a DOT number, must pay a fee in the Uniform Carrier Registration System, and must comply with the FMCSA safety regs and rules. And the information concerning this motor carrier operation, number of vehicles, where they operate, what they haul, who owns the vehicle, or the ownership of the vehicle, and their on-site activities as reflected in the inspection is shown in SAFER. Again, that will be the 4th hour of the program we're doing. If the insured is a for-hire carrier hauling processed goods interstate commerce, then to complete their process of becoming a for-hire carrier hauling processed goods, interstate commerce, their insurance carrier must provide proof of financial responsibility. This proof of financial responsibility is the 91X certificate that is sent to the federal government to complete that process. The 91X in the insurance is found in licensing insurance on the federal webpage that says the name the 91X must be issued in, and it says the limit the 91X must be reflected so that the trucker can operate legally. As a part of this 91X, again, the MCIEF 90 endorsement must be attached to the policy. Thank you very much.